My name is Stephen Millard. I'm the Deputy Director here for Macroeconomic Modelling and Forecasting, and it's my very great pleasure to welcome you all to this year's Dow Lecture. Christopher Dow, after whom the lecture was named, had a wonderful career as a policy economist. He started in 1945 in what was then economic section of the Cabinet Office, that later became part of HMT, where he implemented, quote, management of the economy. So post-war time, very much how to manage the economy. In 1954, he came to NISA for the first time. He was the deputy director from 1951 on. In 1959, he set up the National Institute's Economic Review. He then moved to the OECD, where he set up the OECD's Economic Outlook. So we got the NISA Outlook. We predated the OECD's one. I would still argue, of course, ours is better, but some others may disagree on that. From 1973, he was the Executive Director for Economics at the Bank of England, where he set up the Quarterly Bulletin. Seeing a pattern here, NISA Outlook, OECD Outlook, Bank of England Quarterly Bulletin. He retired in 1981. Like most people who retired, of course, he kept working even harder, I think, for the rest of his life as a special advisor at the bank, as a visiting fellow here at NISA, where he wrote about monetary policy and major recession. Philip Lane, our guest speaker today, has had almost as varied and distinguished a career, one might argue even more varied and distinguished than Christopher Dow. Philip is the chief economist at the European Central Bank and a member of the executive board since 2019. Prior to that, he was the governor of the Central Bank of Ireland and a Whately Professor of Political Economy at Trinity College, Dublin. Those of you with really sharp eyes might notice this is a Trinity College tie, but not the Dublin one, I'm afraid. Sorry. Philip is a member of the Royal Irish Academy, was president of the Irish Economic Association from 2012 to 14. He has acted as an academic consultant at a very large number of policy institutions, including the New Zealand Treasury, the Slovak Budget Council, and of course, IMF, BIS, Fed, etc. His research over the years has mainly centered on international macroeconomics. He's published in a large number of journals, including the American Economic Review, the Economic Journal, Journal for International Economics, and our very own National Institute Economic Review. That's pretty much all I had to say, except that Philip is going to speak to us today about the euro area hiking cycle, an interim assessment. So I'm going to hand over to you, Philip. Thank you.
And you know, he had a book in the I think in that time period, which really had a very interesting discussion about interest rate policy, and this is a lot of what I'm going to talk about today. And of course, he's most known for his contributions to the UK macro policy, but his decade at the OECD as chief economist and the incoming OECD chief economist here in the front row, it's a nice connection. And I would say my contribution to the National Institute Economic Review was I think I more or less finished a proofs just before I became governor of the Central Bank of Ireland. So it's my last opportunity as a pure academic, and I quite like the work I did on the UK current account in that contribution. So I'm very pleased to be here today. So my intention today is that from a central bank point of view, but of course from a point of view, I'm sure many people in the audience here, is now when we date the pivot, if you like, in monetary policy to December 21. So we now have over a year of basically a movement in monetary policy. That's reflected, for example, in the forward curve of interest rates. Even though we didn't start lifting rates to July July last year, there was a pretty big movement in the yield curve from December onwards. So in the sense of the transmission of monetary policy, the fact that the kind of rates at different horizons were going up really from December 21 onwards does mean we have over a year now of initial evidence. Now, on top of that, we do have a hiking cycle in terms of the policy rate, which started last July. okay, that's only a roughly small amount of time, but on the other hand, there's been a lot of hiking. So we also need to learn about this. And the reason why we need to do this is, of course, when we think about monetary policy, there's essentially two steps. One is always be looking at the outlook for inflation. And that is the most important thing, and think about, okay, what does monetary policy need to do? Where are we in relation to our target? But second, in calibrating how much we need to do, you also have to think about understanding what happens when we raise interest rates. What is the effect on the financial system? In turn, what is the effect of a tightening of financial conditions on the decisions of firms and of households and governments, of course? And in turn, how those decisions in terms of economic decisions, levels of activity, in turn affect inflation dynamics. So this is why, I mean, every central bank will tell you the same. There needs to be an assessment of the feedback loop from our monetary policy decisions to inflation. And of course, we can't wait for the end and say, years from now, we can look back and say, oh yeah, that's what happened. We'll do that as well, retrospectively, but in the meantime, we definitely need to make these interim assessments. Everything I say today is interim because you know, it's only early days, but it's also, I think, increasingly relevant for the ECB. So what we said in our last meeting is our assessment of the situation, at least at that time, what was that we definitely intend to raise by another 50 basis points in March, and then we will evaluate the path of monetary policy. And that evaluation really has two parts. One is evaluate the inflation dynamic, and two is evaluate this set of issues about how we think the monetary policy is working. So essentially, that is going to be my goal. And essentially, when you do that, there's really two ways, both are necessary, to think about this. One is to think about macro models. And of course, here at the Institute, the home of NIGEM and other models, this is a natural place to talk about that. In the end, monetary policy works through a lot of channels, which you can only bring together in a macro model. So we absolutely have to think about that. So that's going to be one part of what I want to say. But then second, and I briefly talked to some people this, just before to talk about this, is macro models by their nature tend not to be re-estimated every week. So you also need, in the meantime, to say, okay, that's what the model is telling me, but what is the world telling me? So in terms of understanding what the world is telling you, in what ways is it standard transmission? In what ways is the transmission different in some way under current circumstances? So again, it's interim. I'm going to throw out a lot of charts here. I'm not necessarily going to draw it all together in some big conclusion, but that's basically the nature of today's contribution. So maybe just a reminder that essentially what we have here, and we always might be a bit awkward, but in the end it's true. We do have three policy rates. Now, what is the relevant rate depends on whether you have excess liquidity or liquidity shortage. And of course, these days we have excess liquidity. So right now, the rate that's relevant to the money market is the deposit rate. But, you know, given that earlier on, it's more the refinancing rate. I showed all three rates here. But anyway, what you see over the lifetime of the euro is what we have now is larger increments and a campaign of a number of increases over the last number of months. And you might say, well, if all we want to look at is euro area data, we have nothing exactly like this in the data set. So this is an issue. And it's also true that after a long period of low for long and you know, monetary policy moving in very small increments below zero, this is going to be something different. I would say, of course, you know, we have lots of other data. We do look back in time because, of course, the individual countries had hiking cycles before then. We have plenty of economic historians who go back in time and so on. So it's not the case we say the only relevant data for us is this period. But in some ways, it's also for memory reasons. There's plenty of people in DCB who've been there for the full 25 years. So they understand all of this in their bones. But it's still the case, even those people have not been through what we're currently going through. Okay, let me start with the macro models. And I think it's very important to appreciate that there is not a macro model at the ECB. We essentially run a number of models. So let me explain the different models we have. What's called the base here is maybe the model that many of you, now it's actually relatively new model, but in terms of central bank philosophy, it's very similar to the FERBUS model run by the Fed. And I don't know the Bank of England what they run, but basically it's a semi-structural model. So it balances the fact that you do want micro foundations. On the other hand, there's a lot of reduced form equations here, which basically are a practical way to capture what historical relationships look like between different variables. Okay, that's one model. A second line here is called the BME, the basic model elasticity, because remember we have 20 member countries. And basically what these are basically essentially a kind of summary across all the national models run by the individual central banks. What is the typical response when you aggregate to an interest rate movement? So here I'm just showing one picture, but of course behind that is a lot of individual models. So both of those, basically, there's a lot of essentially reduced form estimation in different ways lurking behind that. So for monetary policy, you have an identification issue there, which is essentially, if you look at the average relationship between interest rates and output, and interest rates and inflation, you have a reverse causality issue, which is typically you raise interest rates if in a world of demand shocks when the economy is doing well and when inflation is rising. So you look at it, they say, well, high interest rates seem to be consistent with an economy doing well. And so you do get this kind of attenuation possibility. Because it's hard in the data to say, okay, because especially when you anticipate, if central banks anticipate future slowdowns and so on, the timing of the rate hikes may confound that. So then we also run, if you like, kind of structural models where you try and identify the causal impact of monetary policy. So get away from the reduced form and say all else equal, if today we hike rates, what are we going to see? And here I show three of these. I'm going to call it the orange line. It's the new area-wide model, which is kind of a well-established model at the ECB. What's called the red line is called the shorthand MMR. So that's named after Massimo Rostagno, our head of monetary policy, Roberto Mato, one of our lead analysts, and another junior researcher, Marcel. And that's basically a kind of modification of the new area-wide model, which adds extra frictions, if you like, which might be expected to generate more powerful monetary policy effects. And then we also found of vector autoregressions. So the BVAR is basically saying, look, let the data speak, but let's identify a monetary policy shock and see how it plays out. And so what I show here is the left panel is the effect on output, and the middle panel is the effect on inflation. And this is basically a persistent 100 basis point hike. And what you see here is, according to the macro models, monetary policy is quite effective. That level of hiking, 100, and remember we've done 300 already. That level of hiking, 100, has a significant reduction in the middle panel in inflation, but it takes a while. And there's a price for that. There's a sacrifice ratio. There's also a significant hit to GDP. Now, what's also true by looking at that, you can see very big differences across these models. So anyone who tells you, we know for sure from our macro models what the impact of interest rate hiking is on GDP and inflation, you can stare at that and say, qualitatively, directionally, we understand it takes a while to get to the peak. So there are lags. Qualitatively and directionally, the effect on output is earlier than the effect on inflation. Because you basically need to slow down the economy before pricing and wage decisions get maximally hit. And also you can see here, basically it's a year, 2 years is where the peak is. It's not sooner than that. And remember our hiking cycle, depending if you think about rates going back to last summer, if you think about the yield curve, which also matters going back to December 21, it was still in the early stages. But I would say none of this exactly shows up in our forecast because the forecasters know all of these models. So they basically cross-check across all of these, and depending on the forecaster preference, whether they take some kind of midpoint of these estimates, or that they take a stand more strongly than that, is an interesting question. Okay, so then we're also not just rate hiking, we're also reducing the balance sheet. And our estimates of what that does is on the right panel here, where we think a reduction of 500 billion does help. It's anti-inflationary. It is also shrinks output to some extent, but compared to the numbers in the other panels, these are not big effects. So this is why we say our primary policy tool is rate hiking, and in the background, the shrinkage of the balance sheet is necessary, but it's not the main event. You're all trying to work out, okay, if that's your kind of hypothetical 100 basis point hike, what put together what you've done so far and what do you get? And these are the calculations from in terms of the cumulative effect on inflation and output so far. And again, the dots tell you the median. If you want a summary number, probably the median is kind of a reasonable way to average across these different approaches. And what you see so far is we do think that the hiking we've done already has had some effect, but we think it's going to have a big effect over the next several years, both on GDP on the right panel and on inflation. Now you might say, if you're telling me you're knocking off two percentage points off 2024 inflation, that sounds rather a lot. And in our forecast in December, we still have 2024 inflation well above 2%. So there's two ways, I think, to interpret this. One is in the not realistic counterfactual. The counterfactual is always interesting to think about. Let's imagine we were completely blind and passive and said, no, we're going to hold rates at minus 0.5 no matter what. Then inflation, we're pretty sure, would remain several percentage points above the target for quite a while. So in other words, one basic role for monetary policy is to avoid instability, avoid inflation remaining too high. And the reason why you say, well, how can you go from 9 or 10% inflation back to 2 in a couple of years? Part of this is base effects, part of this is the expiry of shock. But part is the fact, we've done quite a amount of hiking and there's more to come. The second way to interpret this, complementary way, is let's try and do the best job we can about calibrating. Because if we think monetary policy is this effective, doing too little can mean inflation remains seriously away from the target. Doing too much would also lead to a risk of overshooting in the sense of inflation going below target on a persistent basis. But the overall conclusion from all of this is the macro models, which are some blend of what we've learned from the past data and what economic theory tells us, is doing the amount of hiking we've done will have quite an amount of quite an impact compared to the counterfactual. Of course, the counterfactual is never going to be visible compared to the counterfactual of having maintained the previous policies. Let me say also, with models, you can play around because we know that the world is different now than it was before. And there's many margins at which you can play around in a model by altering different assumptions and so on. And one example is, does it make a difference if you raise by 100 basis points, if you're raising from 4 to 5 compared to, say, from 0 to 1? You might say 1 percentage point is 1 percentage point. But of course, when we think about asset pricing, there's a lot of nonlinearities in asset pricing. So going from 0 to 1 or minus 50 to plus 50 has a much bigger effect on asset prices than going from 4 to 5. And if you inspect all the convex characteristics below asset prices, you might expect stronger effects. So what I show here is essentially the difference between what we might expect if the starting point had been normal interest rates, so the median interest rate in the sample, versus a starting point we actually had, which was super low rates. And basically what we say here is the increase in the risk-free rate will have a bigger effect on investment, both business and housing investment, but also the reassessment of risk. So we also have charts here about the impact of the fact that moving away from super low rates, I'll come to it later on, the banks are absolutely reassessing the risk profile of their customers. Because when rates are super low, broadly speaking, how hard a bank had to work about the debt repayment capacity of a firm was different then than it is now, when debt servicing will be more of an issue. And this is why we say it's not just from the operation of the risk-free curve, it's from the operation of rising spreads. With spreads here, capture both actual spreads, but also it's a way to think about terms and conditions. So if a firm is more likely to reject a loan or to insist on more collateral, all the other ways credit conditions move, not just through the stated interest rate. This is just an illustration. There's many things you can do. Okay, let me comment a little bit about where we are and where the market thinks about where we're going. And again, this is often quite convenient. I'm not going to offer any opinion whatsoever about where we're going, but I can say, well, here's what other people think. And the curve on the left has the market curve, which is a mix of where they expect us to go plus risk premia. And the orange line is what they thought before our December meeting. So before December, they felt the inflation problem was not that big and would disappear more quickly, in part because they felt there'd be more of a recession effect going on in Europe. So in December, the peak of the market curve was a little bit below 3%. Now they think in the most recent data that the market curve is peaking around 3.5. And they think it's going to remain higher for longer, if you like. Below that market curve, the kind of rectangles are what the analysts say. So the people who work for different asset managers and banks, because they're saying what's the most likely path. So there's no risk premia in what they say. And usually there's a little bit, the actual most likely path is a little bit below the market path once you allow for risk premia. But what they do think is essentially these high rates will be here, into 2024. And what's also interesting here is later on, going into 2025, which is a good distance away, when rates do come down, they're going to come down to around 2%. So they're not going back to the pre-shock level. So this is a bit different maybe to the UK and the US. We have here, in addition to the cyclical problem of, getting rid of the excess inflation, there's a new steady state here. Because with the re-anchoring of inflation expectations at around 2%, they believe in steady state, the policy rate will be around 2. So that's lurking underneath. That has an implication for monetary policy because it's not a kind of interest rate cycle where you go up and then come back down to where you started. It's an interest rate cycle where it's moving away from super accommodative now into restrictive territory, but then when it's over, it's back to neutral, not too accommodative. And so when you think about monetary policy and interest rates, this is an environment where people say, okay, it's a new world. I'm never going to have access to the rates I had 2 years ago. The rates I'm going to face indefinitely are higher than they used to be, which is 2 segments. A segment now of above neutral for a period of time, and after it's over, settling back towards neutral. And this is I think the re-anchoring issue is not an issue the UK and the US have, because they were already have expectations around the target, whereas we had under the anchoring to the downside issue. So I think that this is relevant. And again, that's captured here in the survey of monetary analysts, where they think, again, compared to December, the latest survey has been higher for longer, but again, with a fairly stable picture that eventually, when this is all over, the long-term policy rate will be around 2. Let me mention again before turning to some other topics, part of the transmission mechanism is also through the exchange rate. And what you see here, let me focus on the euro-dollar rate. And this is just the course of last year. It is when it looked like there'll be a pretty big interest rate differential between us and the Fed. You had this pretty big depreciation through most of last year. But now that the differential has narrowed quite a bit, you've had until very recently, a lot of that has been unwound. And of course, for all central banks, that helps the inflation dynamic to have some appreciation. But let me say, for us, your area is a continental sized economy. Imports are mostly priced in euro. So the kind of impact of the exchange rate is probably weaker than in some smaller economies. So it's relevant, but not kind of first order. And then let me say, in terms of the transmission, it's important to recall that for us, as I'll come to, the bond market is more important than it used to be. There remains mostly a bank-dependent financial system. And so on the left side here, how is the financial system responding to the rate hiking that we've done? Because in the end, the amount of the real economy, which has access to the risk-free rate, is not that big. It's just the intermediated cost of finance is important. And again, let me go back to December 21, and the red line says those who are in the bond market have seen more than a 300 basis point increase. And you can see here, a lot had happened. Most of that had happened in the first half of last year. So if you look at by June is already 4%. It's a little bit north of 4% now, but more or less the adjustment in bond finance anticipated the rate hiking. And so in terms of the bond market channel, that's been in operation, for a year now in many ways. What we see now is with the cost of borrowing from banks, it's also moved quite a bit, but only really since we started hiking the policy rate. But of course, because they have access to sticky deposits, the scale of the increase so far in bank lending rates is less than in the policy rate or in the bond market. And so that's the cost of funding to banks. On the right side, and to corporates who are in the bond market, on the right side is the cost to households. And what we see here is already a significant movement. I'll compare it to other episodes in a while, both in the cost of mortgages and in the cost of unsecured personal debt. Okay, so let me maybe just pause a little bit about the macro models. Because with the macro models, as I said earlier on, these are not re-estimated every day. I gave you an example where you can say, well, okay, we can play around a little bit to try and sharpen it. But in the end, if you say, oh, that's all I'm going to look at, in a big zone of uncertainty, because depending on the model you look at, you're getting quite different answers. So what you also need to do is a second phase, which is inspect what's going on in the funding markets, in the pass through to customers and so on. This is one element in terms of pricing, but we also have to think about non-price access to finance issues. Because again, we know historically, or it's straightforward in theory, but also conceptually, banks will not just rely on hiking rates. They'll also affect access to finance to being tougher in terms of terms and conditions, granting loans, collateral, and so on. So let me first talk about credit volumes first before getting to these other things, and then say, what are we seeing over this time period? So for firms in the aggregate, the bond market was super active in 21, even in Q4 21. On the left side there, you can see a lot of borrowing from banks and a lot of issuance because the bond yields are quite low. And also, of course, we were helping that with a lot of purchasing. And then what you see in the bond market, since then, the red boxes, it basically stopped. With the bond market moving very quickly in Q1, net issuance was basically a little bit in Q1, then basically zero, in fact, negative for a couple of quarters. It's coming back now because there's no good choices for firms now, because with bank funding going up as well, the case for going back to the bond market has become reestablished to some extent. So what we see now is, most recently, is overall lending to firms has turned negative. Because also there's a lot of working capital needs to do with the energy crisis, which are also fading to some extent. But in terms of volumes, this is a big turnaround, which again, I'll compare to other episodes later on. Of course, it matters quite a bit. Is that turnaround in volumes mostly demand or supply? That matters quite a bit, and I'll come to that. And on the right side, you see the turnaround in households, where again, the volume of mortgage lending, auto lending has come down quite a bit over the course of that year. Again, both demand and supply components contribute to that. I am also I can't remember what you said, 5 hours. You said 5 hours for the lecture? Yeah, okay, so let's see. Okay. Okay, so one thing that we're keeping a lot of eye on, but it's not because it's just interesting, which it is. It's important to emphasize the bank lending survey over the years we've run it have pretty good predictive power about credit volumes 9 months later or a year later. So the fact that there's a lot of movement in the bank lending survey is not just intrinsically interesting. If you're trying to think about forecasting future lending behavior, the history suggests that it's a relevant indicator. It's very important also to emphasize this is a delta in question. We say compared to last quarter, are you getting tougher or easier? So if you think about the level of access to credit, you have to integrate that. But the question is asked as a delta. So what we see here is essentially from 2020-2021, with TLTROs, with supervisory attitudes, with bank guarantees. So a lot of lending was subject to public guarantees. Banks were easing, if you like, and were relatively relaxed about bank lending. Look at the turnaround from Q1 22 onwards. Every quarter, they're saying more tightening, tougher attitude about risk. So you have to add up those up. Every quarter, more and more banks say, yeah, compared to last quarter, we're tighter. So if you accumulate that over the course of the year, there's been quite a big change in the credit standards from banks. Now, at one level, we have to remember the starting point. If the starting point was fairly relaxed attitude, part of this is normalization, going from a relaxed attitude to maybe normal credit standards. And this is going to be ongoing assessment. Is that where we are, or how much of that is going in above normal, the normalization of credit versus into something more restrictive? And you can see across countries, it's varying across countries. But in terms of the kind of timeline, it's in all countries, there's more and more happening. Households, it's very similar, pretty big. So these are pretty big changes over the last 9 months. So again, the attitude to mortgage lending is changing quite a bit. And maybe it's interesting to remember here, because in Germany, the mortgage rates have gone up more quickly. This is quite evident in the German data. It's not just about the periphery. Okay, so one thing, if you move beyond the behavior of banks and you ask how people are responding, we now have this nice thing called a consumer expectation survey, which started just before the pandemic. That's just a coincidence. We decided, the staff decided it's a good idea to follow the New York Fed by having a kind of good consumer survey. But now it's super interesting, and because it's pan-European, because it's monthly, we can learn a lot and we can add in interesting questions as we go along. I would say all of you people who like data, recently it's now downloaded. The spreadsheets are downloaded or downloadable from the ECB website. So you can look for yourself, not just the aggregate data, but also anonymized microdata. So it's a great tool now. And what we have here is people are paying attention to the turnaround. So the left side is that people understand that they think rates have not only been going up, but they expect them to go up more. So it's about over the next number of years, the next year. They expect that in relation to mortgages. They expect it to some extent in what they can earn on their savings account. The people, all the things about rational inattention, do people pay attention to financial conditions and so on? The survey says yes. And then they also, on the right side, we ask, well, if you wanted to get a loan, do you think you're going to get one? And here, the amount of people say, actually, we think it's going to get harder. They're more pessimistic about being able to. So in other surveys we have, it's basically, at the start of last year, if you say, oh yeah, I'm really interested in renovating my house or buying a house, not too interested anymore. And partly because of the fact that they think in the new environment, it'd be hard to access credit. And then when we also ask them, do you think for you as an individual, would you prefer interest rate to be higher or lower? Until we started hiking, most people said they prefer rates to be higher. Now they don't think that. And remember, there's more savers than borrowers in the European households. So you might say it's natural to want higher interest rates. But of course, people who are debtors or want to be debtors, they're not so happy now. And what's interesting on the right is we also ask, well, in response to rising interest rates, are you planning to reduce your consumption? Which is a question really more for debtors than for savers. But what's interesting here, it lines up with what you might expect, is those on adjustable rate mortgages expect the biggest fall in consumption. Those who are renters expect the least. In fact, renters might be happy if indeed the high interest rates also reduce house prices and make it more likely they might be able to buy. So that lines up. What's also interesting is the average elasticity here is super close to the elasticity in our macro models. So totally independent data sources, but what they think is their response to interest rates is in the ballpark of what we put in the macro models. Now, we all know consumption is not super sensitive to interest rates because it's mostly driven by income, not by intertemporal substitution. But again, when you do 300 basis points already, multiply a big amount of hiking by even a small elasticity gets you somewhere. I would also emphasize in the euro area now, which is different here, 8% of the survey have an adjustable rate mortgage. So if you are building a cash flow model of how monetary policy works, right now, the amount of Europeans who have floating rate mortgages in the aggregate is not that high. I'll come back to that in a while. Are we seeing it in the retail data? I mean, consumption data lags quite a bit, but in the retail data, there is some evidence of some slowdown, in fact, a dip in the latest data. So if you kind of are trying to confirm your priors and so on, some people might say, well, actually, maybe there's something going on here about tightening of consumption. Okay, in relation to firms, what's interesting again is the movement in the data. So the left side is the European Commission survey, and throughout most of the recent years, the blue line is, are you concerned about financial constraints? And basically, over time, no. Rates are so low, access to credit is fine. They were basically, having been super interested during the financial crisis and the European debt crisis, that just trended away to a very low number. Look at the most recent readings here. It's gone up quite a bit, but just in the last month or two. So there is a turnaround in firms now starting to become concerned about access to finance. That's also true in the right panel. We might say it's a fair statement, because the blue line on the left is how many firms think this is a severe issue. This is from our own access to finance survey, which the last one was in September, so it's a little bit lagging. So you can read that both ways. One is it's still not many firms. It's still the case, only about 20% of firms think there's a problem here. But that number has gone from about 17 to 20 in the most recent survey, and that's only September. So in terms of the percentage change, there's a little bit of an issue there. And so we'll be looking at this in the surveys coming up. Okay, maybe one thing that definitely everywhere last was an important issue and remains important is, will the high inflation rates get embedded in the anchored expectations? Earlier on, on the left side here, we have the consumer profile. On the right is markets. And on the left, definitely in March of last year, well, first of all, I'm impressed by the fact that people really pay attention to inflation. So the light blue line is their perception of what's happening now or just happened. And that's tracked actual inflation quite well. So people know, they feel that they know what's happened with inflation, which is, again, for people who think there's inattention out there, there's not inattention when the inflation is at this level. The dark blue line is what you think for the next year. And that also went up a lot, but it's turned around now. So now the idea that whether it's because they understand the supply shocks turn around, or they're looking at gas prices turning around, or petrol pump prices turning around, or they're reading about the central bank saying we're going to do a lot of hiking to suppress inflation, they are more optimistic that inflation is going to turn around. But it's also true in terms of the longer term, they're far less concerned 3 years out, but it's still the case, the turnaround in the 3 years out inflation rate in Europe has not turned around. It has turned around in the US, but we still have a concern about that. You might say, well, is that just supply shocks, fading, base effects? Are you sure your monetary policy is hitting home? And on the right side is actually what happened in December. So in December, we both came out with a tougher inflation forecast. And also we surprised the markets in terms of the plan for hiking. And the right side says actually there's quite a big downshift in the following day in the market view of inflation. So these are seen as a big response. So if you want to say yes, our monetary policy is doing a pretty basic task of helping to stabilize inflation expectations. Causality is not so easy, but this kind of event study from December is reassuring. I would say to remind you that essentially what's happened in the euro area is a re-anchoring. The survey professional forecasters like many people maybe also in this room, was convinced the euro area would turn into Japan. So pre-pandemic for many years saying, we don't believe you're going to get to 2%. We believe inflation is going to get stuck at 1.6, 1.7. Now what's happened is there's a concentration now on 2% as the long term. They understand that the feasibility of the lower band is not there, and they understand this clearly, this is what we want to do. And they currently understand, or they think, that the inflation rate we have now will not last, both through the tightening effect and the fading effects. They think that. On the other hand, they also think the next couple of years are going to still be stiff inflation rates. It's going to take a while for inflation to come back all the way to 2%. Okay, Stephen is, and I do have the optionality here because, of course, the detailed paper is on the ECB website. But let me briefly compare what we're doing now to previous hiking episodes. And I think some of the points to notice here is the hiking has been, which is the green line, is you can see the steep slope here. It's been faster than normal. Previous hiking cycles have basically been more gradual, but it's been faster in this occasion. Now, of course, this is a lot of it is to do with the fact that from a super low level, it's important to move quickly. We didn't start in steady state on this occasion. But maybe some of the dynamics, what's interesting here is in that second panel from the top left is credit to firms. It is historically, it took a while for credit to firms to slow down. Because if you just start a gradual hiking cycle, it doesn't necessarily have a big effect very quickly. I showed you earlier on, we think credit to firms is stopping quite quickly. The same in the next panel about loans to households. We think it's going to be happen more quickly on this occasion. And also lending rates to firms has gone up more quickly on this occasion. So kind of the scale of what we've done does mean the turnaround in financing conditions is more than normal. Let me focus on the bottom row what we see again is historically, even a housing market takes a while to respond. So in the bottom panel, in the middle, bottom second from the left, you see housing investment historically has continued to rise before eventually falling. And again, because construction in Europe has been falling since Easter, we think this is already in train. Okay, so but you can read in more detail at that. Okay, I'm going to flash through the last ones rather than dwell. It's very important to also say, well, financial conditions in Europe is not just about what we're doing. It's also the spillover from the Fed and from other central banks. And the point here is to say, look, on some of the indicators we look at, like industrial production, the Fed tightening it has nearly as much effect in Europe as it does in the US. Now, this is global. Firms typically have a global market. So industrial production is not all of GDP, but that spillover is relevant. And on many indicators that we care about, Fed tightening will lower global commodity prices and therefore be disinflationary for the euro area. Another way of saying this is, how do you get inflation from 9 or 10 to 2 by just moving the policy rate to what the market thinks, 3, 3.5? The answer, it's not just us. It's all the tightening globally will also push down tradables inflation. The non-tradable bit we have to do, but the tradable inflation will be coming from global tightening and the reversal of supply shocks. Okay, so let me talk a little bit about also why do we have lags in monetary policy? And I said earlier on, there's a lot of people have fixed rate mortgages. What's also true is if you think about the period of high interest rates lasting for the next couple of years broadly, every week, every month, more and more people will be coming out of fixed rate contracts. More and more firms will have to refinance. And they'll be refinancing at higher interest rates. So on the left side, we show the historically normal financing pattern for firms in Europe, where around 85% is below 1 year. And if you have to refinance at 1 year, when the 1 year rates are high, you face a problem. So right now, firms may have some longer term loans, But when they expire, and they're going to expire sooner rather than later, when they go to refinance, they will face this. So in other words, the power of monetary policy is not just right now, because some firms are insulated, but when they go to refinance, which for firm investment will be more quickly than for household investment, they will face that. So I'm going to skip over that because you do have the option of reading the paper if you get to it. And what I say, and for households, the same also applies. The of course, new mortgages will be a higher rate, and those when you do cut a new mortgage, there'll be more likelihood that you won't get a nice fixed rate deal, and you may go for floating rate. So the left side is what's happening. And look at Italy. So Italy went from having in 2014, 80% of mortgages at floating rate. And then there's a good development in the interest rates and in intermediation. So before the shock, only about 20% of Italians went for floating rate mortgages. Now 70% are opting for floating rate mortgages because of the fact the deals are not so good on fixed rate. So in other words, the question is, the longer this tightening episode goes on, the more the old pattern of being exposed to floating rate debt might reestablish. And so the power of monetary policy is going to accumulate over time. Let me again skip over the savings issue. And then maybe make a few closing remarks. One is on banks. The basic point here is banks are in good shape. Capital ratios are well above the regulatory requirements, which are plotted at the end. Their attitude to lending has been for a long time affected by regulatory macro poo, essentially saying, look, don't take too many risks. So the risk profile of the loan books has over time improved quite a bit. The amount of problematic loans are a lot lower than they used to be. Their kind of valuation ratios are a lot better than they used to be. And so all of that together would point out is we can, the assessment is monetary policy can work quite effectively. There's one potential issue, which is if you do too much, will you cause banking sector problems, which is we don't think so. That there's a lot of room here because banks are a lot safer, better capitalized and so on. That hiking can do its job without having a kind of constraint of triggering problems in the banking sector. Okay, maybe I'll just make one last point, which is often talked about, which is now compared. So those macro models, how they were estimated, definitely includes periods when the European economy was much more manufacturing based than services based. And that might matter for tradability, non-tradability, also matters for capital intensity. Because you might expect capital intensive businesses to be more exposed to leverage and to debt servicing costs than service-based, and there's definitely a lot to that. And so we're mindful of tracking, is this going to alter the transmission mechanism of monetary policy compared to before? What I would say is on the right side, what's interesting is definitely the response of capital intensive firms is sharper. But actually the persistence of the effect on labor intensive firms looks more persistent, because essentially how this operates on labor intensive firms might be more closely connected to the evolution of GDP for levels of demand and so on. The labor intensive firms may not face a cash flow issue, but they're sensitive to domestic demand. And if monetary policy reduces domestic demand, those sectors might be affected. And then the other big issue is to the extent a lot of the capital stock now is intangible. The valuation of intangible capital is probably quite sensitive to interest rates. And so that power might be there, which is true across many services industries as well. Okay, so I've exhausted myself, I've exhausted you, and I'm sure that some of you may want to ask a question or two. So let me basically conclude here, which is basically the intention is basically and I'm sure I'm going to come back to this topic many times, quarter by quarter, we're going to learn a lot. Every central bank will tell you the same thing. There has to be a feedback loop from what we learn into monetary policy. If it turns out the transmission is weaker, more needs to be done. If it turns out transmission is stronger, less needs to be done. And so this is obvious. It's a big learning episode. And what I tried to do today is say, well, there's quite some work by the staff to put this together. But then, I don't know, 3 months from now, 6 months, updating these charts. Let's see where we are. And of course, that is, as I opened with, that is one of the tasks for central banks. The other task, of course, is perpetually reassess the inflation dynamic. And it's some mix of reassessing the inflation dynamic, updating our views about the transmission mechanism, and put those together will tell you the future of monetary policy, which you can all guess for yourselves. Okay, thank you.
Okay, we have time for questions. I'm going to collect them in groups of 3. There is a microphone that will come round. If you could please, before asking your question, tell me who you are and who you're working for. We'll start with Sushil.
So I'm Sushil Wadhwani, Egypt Wadhwani. Thank you very much for a very interesting and actually refreshingly open talk by a central banker. So thank you for that. I mean, my question is a simple one, and it affects both how much you might need to tighten and also how one can interpret the results from the models that you showed us. And it all turns on the simple, obvious thing about the extent to which expectations have become de-anchored.
Yeah.
I may have misunderstood this bit, but you seem to be placing quite a lot of weight on market-based expectations. Now, personally, as a market-based participant myself, I place virtually 0 weight on them in coming to a view on future inflation. Even if you just look at the last 3 years, if instead of looking at market-based inflation expectations, you just listen to what firms were saying about what they expected to be able to do to prices or what they expected to happen to their wage bill, that's been much, much more accurate than anything the markets have been saying. Apologies for this long-winded question. I'm coming to a conclusion. So the problem at the moment we have is market-based inflation expectations are relatively benign, but firms in several countries are still expecting pretty high price and wage growth even 3 years out. And therefore, it seems to me there is some residual doubt that there is de-anchoring, which must therefore inform both policy setting and any interpretation of model-based results. Certainly my experience with the models we run internally is that because there was such a sharp discontinuity in the 90s, our models, using data post-95 did a very bad job 21, 22, but our models from the mid-70s to the mid-90s did a great job in predicting 21 and 22.
As the microphone.
Thank you, Lorenzo Codogno, LSE and other things. Thank you for your presentation. I have 2 questions, actually. One is, before COVID and before Ukraine, there was plenty of evidence that the Phillips curve had flattened. And by the way, one evidence is also suggested by your survey of professional forecasters showing expectations remaining below target for a long while. Are you now suggesting that the Phillips curve might have steepened again, given also the evidence on the transmission through the banking sector, which appears to be quite effective, actually, according to your figures? And the second graph, the second question is related to this graph, which shows, you know, the kind of capital intensive output. But I wonder whether this is really significant because at the end of the day, what really matters is the level of debt.
Okay, and there was one question between Abinay and Adrian.
Hi, Mario Pietrunti, BNP Asset Management. Thank you for the insightful assessment. There's one thing that perhaps is missing in the presentation is the assessment of where the natural rate is. The models you showed us are inherently linear and they work around the steady state, which at the moment we don't know where it is. So my question is, assuming that there could be stronger nonlinear effects the further you move away from the natural rate. And considering that the number that everybody has in mind, the 0% real natural rate, is at the upper end of the estimates that the ECB itself provided before the pandemic. What if the ECB overhikes? What if the ECB pushes rates way too far above neutral? How should we read the reaction function once the ECB acknowledges that in a few months' time? Thank you.
Okay, over to you.
Okay, thank you. So let me talk about the base model that we have. So one of versus the base model is you can take a different attitude or insert a different view about the expectations of market traders versus the expectations of firms and households. I think that's a nice framework because those who are paid to kind of follow. So the expectations of market people matter for the price of the yield curve. In turn, we care about the price of the yield curve. So regardless if they're crazy or not, it is a kind of issue for monetary policy. Is that? But what I showed you there was the consumer expectation survey, which by this, thank God we actually developed that. And again, it's not me, it's the staff decided to do it. Because without that, we would be blind about consumer surveys. And it's super informative. And what I've tried to say over the last number of months is we should not be complacent that people who say eventually get back to 2, nice. It'd be worse if they thought eventually we wouldn't. But the expectation over the next year, over the next 2 years, over the next 3 years, that's really what matters for pricing decisions, because too far out is just too abstract. And that's why the phrasing we have is return in a timely manner. Now, we're not going to take our time about it. We're not going to say be reassured because eventually there'll be conversion to 2%. Because inflation will feed in itself if it's kind of that, you know, horizon of 1 year, 2 years, and so on. So how do we deal with that? So I showed you the household data. It remains the case exactly how households act on those beliefs is not clear. So what's really interesting is the decision of firms. I mean, they can read the survey and say, oh, households can be bamboozled. They think inflation's high, so I can run through a price increase. But for the firms, what we have. Number one, I should say the survey on access to finance of enterprise, the SAFE, is now going to become quarterly and we'll have an inflation section. So we're going to now have a regular survey on the expectations of firms. The Banque de France is a super survey like that, which has been very interesting. But we also have what's called in an archaic way, the corporate telephone survey. I'm not totally sure it's all over the telephone these days. Maybe there's some emailing going on, but the corporate telephone survey has actually, going back to what you said about what was really convincing in the last couple of years, in both directions, is convincing. Look, it's insane, and more recently they're saying, well, actually, we see some moderation. So there is an issue there because we typically talk to the most successful firms, and they're also global firms. So when they answer, say, okay, how much of this is your area? How much of this from their operations in America and so on? But no, I fully I agree with you. And this comes in from modeling choices, for forecasting choices. In our December projections from the staff, some people in the outside world, well, you know, what's happened here, because, you know, some of the exogenous assumptions should look better. On the other hand, you know, there is a basic conclusion. There's likely more, because from what everyone is saying, there's likely more persistence in inflation. And that persistence is basically coming from a temporary phase of elevated expectations. And also some catch up to the surprise inflation that definitely happened last year. What's in the Phillips curve? I mean, there's two issues there. One is, I mean, if the basic idea is slack influences inflation dynamics, what we see here, yes. And what we had in the pandemic and with bottlenecks is slack was being generated by diminished production capacity. If you couldn't get your microchips, car firms could raise prices. If you want to buy a car, we don't have that many cars to sell you, so we're going to raise prices. Firms who didn't have the usual elastic supply of immigrant workers, you know, staffing hotels, restaurants, you know, the other margin adjustment is to raise prices. So I think it's, you know, a huge endorsement of the relationship between slack and pricing. For wage inflation, I mean, the core Phillips curve is, of course, the cliche. It's not a Phillips line; it's a Phillips curve. So it is convex, and of course, when you get into tighter territory, I mean, I see this a lot. I mean, essentially, the relationship between unemployment or other indicators and wages can be very weak when basically this is enough. It is, you're beyond some level of slack. But then when slack narrows, then you can have a more nonlinear response. So I think you know, I think that framework holds up quite a bit. But you have to think about what is it under these circumstances, what the right measure of slack is. The natural rate question is there's different issues going on here. One, personally, when I talk about the natural rate, I basically mean the asymptotic rate. When everything dies down, that's what we might expect to be the kind of real rate. And you know, I've said I'm agnostic about where that's going. There's all sorts of forces in all directions. And you know, I've definitely published in the past interval estimates, most of which is below zero. But ballparking it, you know, around zero is essentially. But what's relevant, again, for a lot of things is, it's not my view, it's what people who are involved in pricing the long end think. And what they think is they obviously carrying in their head right now around zero. So they're pricing the policy rate when all of this settles down to be around 2. That's relevant. So, and again, it's an interesting, is that a very robust you know, view of the market? It will be interesting. And I mean, Peter Gopinath at Jackson Hole last year, you can look at the slide deck. There's a nice kind of slide that here's all the theories which some people have high conviction on about why the real rate is going up. Here's all the theories where people have high conviction on where the real rate is going to go down. So if you want to place your bets, feel free. Now, there's a different concept, which is in response to the shocks we're actually observing. It is the kind of rate that stabilizes inflation higher than normal. So that's also an interesting concept. And like, you know, the Laback-Williams type models and so on would have some of that in there. Another way of saying that, in order to reconcile why inflation is so high when the, you know, in recent times, some people might look, well, actually, policy rates have been too low compared to the cyclically relevant real rate. But that's a little bit arcane. But what I'd say is, you know, the my answer is, but basically, in terms of what's going on, the ratio of cyclical to steady state is high. So I'm not overly concerned about where the steady state rate is, because with inflation so high, and with all the reasons why it can feed on itself, the big issue for central banks is solve that cyclical problem, and then I'll worry about steady state issues later on. And that's basically, so I think the range of variation of what we're seeing is mostly cyclical. It's not steady state.
Okay, next set of three, next to Jagja, then this gentleman here. There's a microphone coming in.
Hi, this is Wei Ye from UBS Capital Risk Management. So one of the major issues we have under the post-2009 regime is to disentangle the impact of base rate changes from the changes of QT and QE. So how sensitive are the results to the changes in the scale of our QT or QE exercises? And if they are really sensitive, how do you suggest we interpret those results? And if they're not so sensitive, that raises the question, why have we not done more QT? Thank you.
Reza Moghadam from Millennium Capital. Thank you very much for a really excellent speech and a fantastic set of charts. I wanted your comments on three very brief points. One, I was surprised by you showed the impact of QT on inflation is much smaller than rates. And I wonder if that is correct, given we really haven't had much evidence, and whether that underestimates. If you interpret your chart literally, it means there is not really much trade-off between the two, but maybe because we have not had a lot of evidence, maybe the impact would be actually higher than the models suggest, number one. Number two, I think you made a very persuasive case that there is a lot of tightening in the pipeline, and the impact of that is going to come in the next few quarters. With that in mind, how do you, the markets focus a lot on current rates of core inflation. I think, do you think we are overemphasizing core inflation? And finally, you had very little on labor markets. There is a school of thought that says policy is not tight enough until labor market adjusts, and labor markets have not adjusted. Do you see that coming, or do you think there has been a sort of shift in paradigm? Thank you.
Thank you. Andre Meyer from Tudor. You started by stressing the wide range of estimates for the impulse response function. I think inflation went down by anywhere from 10 to 40 basis points in response to 100 basis point monetary tightening. If you take that seriously, then the extent of tightening you need could be anywhere in a very, very wide range. Yet if I look at recent market developments, there's a broadening consensus that will end somewhere around 350. And some ECB speakers have encouraged that by saying we want to be done by the summer. So that also takes you roughly into that range. Do you think that's overconfident to think the lending zone is so narrow given the vast uncertainty that speaks out of your models? Thank you.
Okay, so some interesting questions. So maybe if you go back a year, and maybe many people in this room were also right, what's going to happen if the ECB stopped purchasing? What would be, how will the market react to that? But the right way to think about it is, what is all else equal in that question? And the answer is very different if you say, well, what's going to happen to the market if the ECB raises interest rates by 300 basis points before it starts QT? And broadly what we're seeing, and this is that essentially in terms of the impact on sovereign markets and bond markets, it is at a higher interest rate, more people will be interested to buy. So in terms of the visibility of so if we'd stepped away at super low rates, there would have been an interesting absorption issue. When we are stepping away at much higher rates, as far as I read and can tell, people are showing up to buy bonds. So this is basically, and to the extent if you price, of course there's risk premium and so on, but when you think about QE works through and QT through term premium. And then you have to think about what is the ratio of the expectations component of bonds versus term premium. And then you think about, compared to the level of interest rates, the contribution of term premia to the overall change in financial conditions. That's why we have to frame the question like that, as opposed to orthogonal. And remember also, what we're doing is having a kind of orderly, predictable, but moderate QT program where the amount of PEP is fully reinvested for until the end of 24. APB will be basically 50% reinvested, more or less. So this is, it's not the case. There's a lot of QT going on. I would say, I think part of Ray's question is, does it all operate through the yield curve, or should we think about QE, QT? When you think about the balance sheets of intermediaries, think about their attitude to risk, to credit standards, all these other things. I'm very sympathetic to thinking and looking at other dimensions. Honestly, this is through the yield curve effect. So it's maybe in the text, maybe we're more precise about what we did. So today I'm talking about the transitional model. I'm not really going to address questions about other dimensions about what we think about the labor market and so on. No doubt I'll come to that, but I don't really have anything particular to say today, because I don't want to be particularly open-ended about that. From my inflation blog post from November, I think the core, because there's a lot of temporary factors in core at the moment, both from the energy effects and also pandemic effects, that just a raw focus on core, from my point of view, is incomplete, to say the least. The uncertainty effect, this is why the overriding, the ultimate philosophy of the ECB, or every central bank, is data dependence. So the Overton window, if you like, of let's focus on that pretty narrow debate, is subordinated to data dependence. It's subordinated to also the more overriding commitment, which is we will do whatever is needed to bring inflation back to 2%. And we're not. And the ECB, we don't publish dot plots. I don't say here's my view of what the because it's overstating what we know to say here's our clear firm expectation of where rates are going and so on. So the message from us, I think, collectively and me individually, is those decisions will be in line with the unfolding data. Now, I'm not going to help people that much by saying what's the balance between forecasted data versus hard data, what ways. We do say in the most recent statement, essentially there's a criteria essentially that underlying inflation needs to improve. But that doesn't mean there's an equality between underlying inflation and any one indicator. There will be a filtering process to think about, okay, what's really underlying here? Because we could see movements in various inflation indices for base effects, favorable supply shocks and so on, but it doesn't necessarily mean the persistent component is moving to the same degree.
Okay. Unfortunately, we are almost out of time, so I'm going to bring a halt to questions. I would like to do one thing though, which is to present Philip with this wonderful medal to commemorate what was an excellent.
Thank you. This is
thank you.
Fantastic. Thank you.